an important element from a market perspective. When Russia-Ukraine happened, it came out of the blue, right? Nobody was expecting that. Here, there's a region that has been in constant conflict for the last...
For decades. Why should we be worried if interest rates are high in the US?
I think 2008 was a watershed moment in terms of financial markets. What happens is once you give the Kool-Aid, right? We got the Kool-Aid. I call it the Kool-Aid.
Which was zero interest rates.
Which was zero interest rates. Absolutely, right? So basically, you made money free. That regime has changed.
Yeah.
The investor confidence in China is broken, right?
It's broken.
Is broken. I feel, Surabhi, and I'm happy to go on record saying that between 25 and 27, India will see a super equity bubble cycle.
Hi folks, and welcome to another edition of the CNBC TV 18 Market Cafe. I'm your host Surabhi Upadhyay. I hope you folks have had a great week. I know I have had one, though I must admit that there are a lot of concerns that one is dealing with of late. There's the unfortunate situation that's playing out in the Middle East. And then over the last few weeks, actually the last few months, you would have been hearing a lot of chatter around high US interest rates, surging US bond yields, particularly the US 10-year yield. So I thought it's a good time to call someone who understands these things and who can kind of demystify or simplify them for us and help us connect the dots. My guest on the show today is someone who travels a lot. He looks at the global debt markets very, very carefully and speaks to a lot of foreign investors while having a hawk eye on Indian equities right here at home. The guest I'm speaking about is Shiv Sehgal, who's the head of capital markets at Nuvama. So let's get started. Shiv, first of all, thank you so much for taking out the time and putting in the effort to come all the way over here. I know it's a busy day, but I really appreciate it.
No, thanks, Surabhi. Thanks for inviting me.
And it's a refreshing change, I must say. Usually we see you in your black suits and the pinstripes. So this is nice and relaxed. I quite like this.
Yeah, I'm feeling relaxed too. So thanks for that.
Awesome, awesome. So I think our coffee will be arriving shortly. But as we get started, I just thought it's a good time to sit you down because I know that you deal with a lot of foreign clients, you do a lot of travel, and over the last 1 or 2 weeks, I think the market is completely overtaken by concerns which are not emanating from here, from India. These are global concerns that we're talking about.
Absolutely.
So let's start with what's happened in the Middle East. I think that's top of mind right now. Geopolitics, can that be a real worry for markets?
So, Surabhi, I think firstly what people and the audience needs to realize is that, we have had a pretty benign environment in terms of geopolitics, right? I mean, the last century, we had 2 world wars. India became independent in 1947. And then post that, we saw almost within 25 years, India fighting 3 or 4 wars, right? And that's very close to home for me because my father was in the Indian Army. He actually was in the infantry. So he fought all the 3 or 4 wars.
Okay.
And,
wow.
I know from, the stories that Dad used to tell us when I was growing up, the horrors and the cost of the economic and the human lives that war causes on both sides of the fence. Yeah. Right? And then, of course, the world that we are in this decade or this century, the war conflict has moved more towards terrorism and different kind of war. Right? There's cyber terrorism, most part of the world post the Second World War, it was all about the Cold War between the US and Russia.
Yeah.
Right? Yeah. So from a geopolitical environment, I think we have been
wars
lucky.
are not new in that sense. I mean, we've kind of lived with them.
Absolutely.
Actually, I think a lot of people and experts also say that wars start fueling economic boom because there's that much more construction. I mean, that's traditional economic theory, right? But why I'm asking is that in recent memory, we all know what happened in 2022, the Ukraine conflict, and the markets were affected.
Yep.
Would you say that was an aberration because one of the parties involved was also a very big oil-producing country? So basically, my simple question, should we be concerned about this conflict in the Middle East? So,
Surabhi, again, very rightly said so. I think I would put it in 3 buckets, right? Why is war an important element from a market perspective, right? The way you need to bucket that is the conflict going to give tension to natural resources? The second bucket is economic activity, right? And the third is the escalation element to it, right?
When escalation.
Wider escalation, okay. Right? So, for example, when Russia-Ukraine happened, it embroiled the entire Europe. There was a Russia-China ally, right? So, there was an escalation concept to it. Right. And what I would also bucket is that the escalation from a nuclear weapon perspective as well.
Now, there was a possibility.
Absolutely, right? Yeah. But when I look at, the recent developments that have happened in Israel and Hamas, right? I think to me, from an economic activity point of view, it is an isolated event from a large economic base, right? It is not a large trade center from that perspective. Yes, it's important. It's important in terms of how much it can escalate into the Middle East. You know, who does Iran side with, who does Saudi Arabia side with? And also from a natural resource point of view, you know, there is not really that element there. There are peripheries that are embroiled in the oil production, right? But it is not a direct element to it. Right?
Correct.
So, and the other thing to very important is there is an unknown, right? When Russia-Ukraine happened, it came out of the blue, right? Nobody was expecting that it was not on anybody's radar, right? Here, there's a region that has been in constant conflict
Turmoil
for the last
for decades,
since the term, you know, it got independent, right?
Fair point.
So there is also an element that yes, there is a conflict element. We went through a period where, you know, things were benign. It's taken Israel by surprise, and of course, any escalation has concerns of its own. But I think, like, you know, Russia-Ukraine war is still on, but we're not talking about in markets.
Absolutely.
Right? It's become a known unknown, right?
True.
And I think fast forward within a couple of weeks from now, in my mind, I don't think this escalates into something serious. But what is happening at the moment is terrifying.
Absolutely. The humanitarian sort of issues that are unfolding are massive, and they're really heartbreaking. And we really hope, for humanity's sake, that this really draws to a close. But okay, so what you're saying is, from a stock market or in general financial market perspective, maybe markets will just move ahead and learn to live with this one.
Absolutely.
Okay. So then let's talk about the other trouble, right, that we've been speaking of, and that is higher US bond yields. Now, I want you to really simplify this for a lot of our viewers who might be new to stock markets as well. First of all, why should we be worried if interest rates are high in the US? Okay,
so that's a great question, by the way.
And it's investing 101 here on the Market Cafe.
No, so let me try and simplify it. I think, you know, the world that we live in, right? There is a cost of capital to everything that we do. From the coffee that we are drinking, to the production that's happening, right? To everything that you do. Do you drive your car, the oil price? Everything is dictated by the cost of capital, right? Or the cost of doing business.
Yes.
Now, every element there is dictated on the fact that what is the cost of borrowing for that business.
Absolutely.
Right? Money is not free.
Absolutely.
Right? However, saying that, we lived, I think 2008 was a watershed moment in terms of financial markets. When 2008 happened for the first time, right? I think the entire financial markets was in such big turmoil that the central bankers that be and the powers that be decided that we had to cut rates to zero for the financial system not to collapse, right? But now what happens is, once you give the Kool-Aid, right? The Kool-Aid, I call it the Kool-Aid.
Which was zero interest rates.
Which was zero interest rates, absolutely, right? So basically you made money free, right? Now when you make money free, right? It's good because it avoided the collapse at that point of time.
Yeah.
But what is surprising to me, right? And I'm a good anecdotal student of financial markets and history, right? Fed kept the interest rate zero for 7 years, right? And that percolated into other problems. It equated into a NASDAQ bubble. It percolated that into, you know, a private equity bubble. It percolated that into a crypto bubble. Like, money will flow, right, into where it finds its best value and best yield. And COVID, on top of all this, was another event that happened.
Then you had low interest rates. Correct. Because, well, what do? You have to, you know, pump prime your way out of this crisis.
Absolutely. So you had both monetary and fiscal, right, basically providing you these massive
injections of liquidity.
Absolutely right.
You travel to the US as well, right? I don't hear people that bearish on the US economy just yet. Yes, there's been talk about some rumblings in the banks, etc. So that's my first question, whether you're really that concerned that we're going to see an economic meltdown or some sort of a business meltdown in the US. And second, while there is a moral argument about free money pumping up markets, and we've seen enough some great documentaries on OTT platforms, which I love to watch about what happened in 2007. But financial markets love free money, and no one argues as long as the price of stocks and bonds and, you know, crypto and crude, it all goes up. No one has a problem in the financial markets. So then why should we worry?
So, Surabhi, again, great question, by the way. And let me rephrase that by saying why we should be worried, right? The answer to your point is that from 2008 to 2021, we lived in free money, right? That regime has changed, right? And I'll give you some anecdotes and some statistics for the audience, right? Global debt today, as we stand, is $367 trillion, right? Pre-GFC or global financial crisis that we call, in 2007, right? That number in terms of US, since you asked the US question, US debt, US national debt today is $33 trillion, right?
Okay.
In 2008, right, that number has gone 3x.
So from 2008 to
now, we have
US
debt has gone by 3x.
3x.
The refinancing has to happen, right? You cannot borrow money for perpetuity, right? Either you borrow it for if you have a home loan, you borrow it for 5 years, 10 years, 30 years, right? But it all comes up for refinancing.
Correct.
So the refinancing cycle in the Western world is about to happen in the next 2-3 years.
And now the cost of refinancing is some 4.5 or whatever, 4.8%.
Absolutely
That's
right.
the US 10-year bond yield.
Absolutely right. I don't think that we go back to the regime where interest rates are going in the near term anywhere to 0 to 1%. So this refinancing, right? This $33 trillion, right? That the US government owes, till about a year back, that cost was $300 billion to furnish that debt.
Okay.
Right? As we stand today, that number is $970 billion, right? That they need as interest expense to keep the deficit going. And if interest rates continue to balloon higher, right, that number only becomes higher and higher.
Just to conclude this point, bubbles burst for a reason. Bubbles can go on for years, right? And then there comes some point or some event which pricks that bubble.
Correct.
In 2007, because I was around, I was covering financial markets. I remember that was a subprime market. The moment home prices started dropping in the US, all these fancy bankers would, package these securities as mortgage-backed securities, and they were making huge money out of leveraging them. The whole thing came crashing down.
Yeah.
So it was the fall in the real estate market that pricked the bubble. Any sense of what could prick it this time?
So the way I look at it, there are only two reasonable scenarios, outcomes. Like markets are all about probabilistics, right? So I can simplify it for your viewers, right? One is that the slowing economy actually has a tipping point and it goes into a proper recession.
Okay.
Right? That's first element.
Okay.
In which case, as you rightly said, the Fed will cut rates and come to the rescue.
Yeah.
Right?
Okay.
The second scenario is that yields keep rising, right? And it actually percolates into another financial crisis.
Just very high yields.
Absolutely.
And the accidents, like some of the examples we had around April or so when these mid-sized US banks started failing.
Absolutely right. Right.
Okay.
So those are the two only scenarios that I can see. The third scenario is that we continue to muddle through, right? In a very slow moving economy, global growth is weaning off, right? But there comes a tipping point where when the refinancing issues, the real estate issues in the US, right, actually cause a inflection point, and we see these anecdotes come playing out in the US.
Okay, let me tell our viewers this. Guys, you probably think what's going on? This is such gloom and doom talk. The world is coming to end. But hang on. The person who's sitting before me is very bearish, no doubt, on the way this global debt picture is shaping up. But at the same time, he is super bullish on India. Aren't you, Shiv?
I'm super bullish on India. India finds itself in an aging world, in an indebted world, in a very sweet spot for the 5 Ds that we at Nuvama have refined for the last few years. Right?
5 Ds.
5 Ds, right?
Which is why you think, India is in a great place.
Absolutely.
Okay.
The first is deglobalization. We lived last 20-25 years because of the China theme. It was a global world.
Okay.
Right? Given what has transpired post-COVID, everyone wants to secure their supply chains. I think this whole deglobalization theme is going to play into India's hands. Manufacturing, friendshoring is going to overtake than offshoring.
I mean, the way a lot of the supply chains want
Absolutely.
to move
The
to
reason
India.
why Apple is coming to India, for example.
Okay.
Right?
Okay.
That's one. The second is deregulation.
Okay.
The Western world is going through a heavily regulated environment, right? Whereas in India, the reform push that we are happening, the tax cuts that we are seeing is providing a lot of growth momentum in terms of confidence to investors, right? So that's deregulation.
Okay.
The third is debt. We have talked a lot about that, but all I'll add is that
a lot of debt in the US.
A lot of debt in the Western world.
Yeah.
But in India, India is the only place where debt to market cap GDP has moderated in the last 10 years. Corporate balance sheets are a lot unlevered today than they were 10 years back, right? Fourth is the demographic dividend, right?
Yes, a young population.
Absolutely.
Yeah.
We are going to provide 20% of the world labor workforce, right?
Yeah.
And we keep talking about that on every public forum. Everyone knows the answers to that, why that is relevant, and it's an aging aspirational middle income group that's going to drive consumption. And the last, to me, we are the largest democracy in the country. Democracy is the largest democracy in the world, right? And it is one element that is missing in terms of Russia and China.
Absolutely.
Right? So those to me are the 5 Ds.
5 Ds. That's deglobalization. Then there is debt, which we have less here. There's a
Deregulation.
Deregulation. democracy and the demographic dividend.
Absolutely.
The 5 Ds. I know the 5 Ds which are making India stand tall, I guess, in the global financial landscape. You know, on the deglobalization bit, I want to ask you, because I know you travel a fair bit around the region as well. There's this whole talk of China. You know, when we started the year, it was the sell India, buy China trade. And then somewhere in between it was like, okay, no, now China is recovering. So maybe go back and buy China and maybe unload a bit from India. Where is that trade now? Who's selling what and buying what between these two giants?
So I think we have to understand that, you know, China was a big theme over the last 20-25 years.
Yeah.
Right? It was a large part of the EM basket. It was a large part of the global, growth elements as well. That's flipped over, right? And that is playing into India's hands. Because we were not a large partner when China was growing, right? When it degrows, the pockets that will be hit will be Korea, Taiwan, Indonesia,
Because
Australia.
They were all sort of piggybacking on that.
Absolutely.
China
They were
growth
large
story.
partners. What I do feel is that is playing into India's hands. When I speak, in my travel, when I meet especially the large asset allocators in the world, right? The investor confidence in China is broken, right?
It's broken?
Is broken. Absolutely broken.
Really?
Yeah. Okay. I think there are, not only from public markets, but even from private equity perspective, there are not many deals happening, right? I think the amount of money, incremental money that will go into China, at least in the near term, until some big policy developments take I would say, a flip.
Yeah.
I don't see money moving back into China in the near term. To the extent it should, given the large size of the economy.
So then that money you're saying may find its way into India?
It's not may, it is happening in India.
Okay.
Right? If you look at the data for this year as well, India is not probably, 50% of EM flow that has happened in Southeast Asia, 50% of that flow has happened into India. India's, we all know this, 14.1% of MSCI EM is now India.
Yeah.
Right? I think that number only continues to expand. And, just recently we had this whole news of JP Morgan, making Indian bonds investable and adding them to the index. That's going to see $25-30 billion of inflow, right? I think the Western world is waking up to the fact that India representation in global asset allocators is underappreciated, right? And I still see pockets of money, not little, but lots, especially in the Western world, where people have been talking about India. Everybody has been waiting for a pullback in India, right? Which we know is not happening, right? And my point is, as this whole confluence of seed spots continues to improve, right?
We will see money will come in.
That foreign money will be on top of the underlying layer of $35 billion of domestic inflow that we are already seeing. I feel, Surabhi, and I'm happy to go on record saying that between 25 and 27, India will see a super equity bubble cycle.
Okay, between 2025 and 2027.
I think the grassroots have already been laid.
Super equity cycle, almost a bubble.
Absolutely.
Wow.
I think that you will see the maximum gains, and there are enough anecdotal historical studies done on this.
I'm going to remember this.
Right? Where when an economy goes from 3.5 to 6-7 trillion, right? Which is what we are going to do in the next 4-5 years, right? We are going to see the maximum gains, benefits made in the equities.
I straight away have to come to now the brass tacks questions. How do you prepare for it? What do you look at? What should portfolios look like? And what should investors do to prepare for this huge boom cycle if it's coming?
So my first answer is that India remains a buying market, right? If you see any opportunities, right, it's going to be a volatile ride. Nothing is one way, right? It is going to be a volatile ride. You need to make sure that now, since we have talked so much macro, that your micro is right. You are sticking to the right management, right? Cash flow generating businesses that are not dependent on high debt, right? And there are umpteen number of companies and businesses and sectors that I'm super bullish on. And I'm happy to lay it out there. Even at Nuvama, we feel that theme is going to play out. Given the domestic consumption play in India, right? We are very oriented towards domestic themes that will play out, right? One is domestic autos, for example.
Okay.
Domestic autos, have been in a benign environment. Sales have started picking up. We remain very, and I'm talking about autos and auto ancillaries both.
Sure.
Right?
Sure.
Cements.
Cement.
India government has announced that they're going to make 1.4 trillion of capex in the next 5 years. Right? The spend on capex in infrastructure is going to be...
real estate, you need cement for everything.
India is in a transformation age which people don't understand. China went through that between 1995 to 2010. India is in a similar phase, right? Where there is capex going to happen. I remain very bullish despite my negative view on interest rates. Okay, I remain very bullish on Indian real estate.
Indian real estate,
right? I think, also I look at cycles. We have had 10 years where,
it was a down cycle,
Absolutely, right? We are just entering that cycle.
The upcycle in real estate.
Right? So I think real estate, you'll be amazed. Well, if you look at the monthly data of the registrations that are happening in Mumbai and Delhi NCR and Bangalore, right? They're all on an uptick.
Yeah.
Right? So any domestic related themes, I'm extremely bullish.
Okay.
Right?
Real estate, cement, construction and domestic consumption.
And infrastructure.
And
infra plays. Right?
Okay.
I think, you saw what happened with the railway stocks recently. Right?
Oh, yes.
Absolutely. Right? So I think you will find pockets and themes where in the next few quarters and years ahead, right? Yes, you want to take some profits if things go, the mid caps had a great rally. Yeah. You want to take some profits on the table as and when things get euphoric. Okay. But again, I'm happy to say that I think the euphoria, I don't think I can envisage the euphoria that we will see because, when US started on the path of outperformance, right? We could have said it is a bubble in 2012, in 2013, 2015, right? Till 2021, the outperformance of the Nasdaq continued to happen.
I think that's the biggest challenge that a lot of investors also face because you always have this debate about valuations and whether this has become too much, this is excessive, or whether this time it's different. These are the catchphrases in the market. I think we're trading at just about 20 times thereabouts right now.
2024 is the range that we will continue to trade in my view.
So you're saying 20 to 24 times on Nifty if you're looking at Nifty forward earnings. So we shouldn't get worried with valuations. We should be ready to prepare for higher levels, higher stock prices and higher index levels.
So your margin of safety is going to come from valuation, no doubt. But the reality is I've read and studied and played part in some of these bubbles, right? Given, the white hair that I have. The reality is that I want to say that if you overlay the liquidity cycle, that the money flow that is happening from a domestic scene, the foreign money that is about to come into India and is continuing to come into India, if I juxtapose that, I superimpose that with the business cycle that we find ourselves, I think we are in a superpower situation, right? Okay. So again, I'll overlay that next 3 to 4 years, right? Any pullback in my mind needs to be bought into, right? Because you will see outside gains and outside performance. Because it's not only an absolute game, it's also a relative game.
Sure.
The world is starved for growth.
Yeah.
Right?
Yeah.
Right. Again, the world is starved for growth and that growth is happening in this monsoon belt. It's not only happening in India. The Middle East, India, Southeast Asia, right? From Singapore till Dubai to maybe Saudi Arabia, right? That's my belt where I think the next wealth creation will happen and the West will deteriorate.
Okay, those are long macro calls coming through. Okay, so I think, Shiv, you've given us a lot of food for thought. Let me ask you, I think the one most important tip that you gave us was buy every dip as you're preparing for the super cycle. Anything else that you want to advise people should keep in mind?
Do your own due diligence, do your homework. I see too many people approaching me and approaching people in the market, give me a tip, but no tip will work out. If you don't have your own conviction and if you're not done your own homework, and you need to be inquisitive and you need to have a broader framework. And if within the framework you have done your micro research, stick to it with conviction. I'm sure you will, it's going to be a wealth creating opportunity.
Super talking to you. I feel very charged up, extremely bullish and extremely optimistic looking at the future. So thank you for this great conversation.
No, thanks. I enjoyed it very much.
Thank you for watching CNBC TV 18 and do follow us on all our social media platforms for news, updates and more.